Chicago's state of the emergency is more than a local issue. It's a warning for the rest of the country. I'll show you why what's happening in Chicago matters and how it's going to affect every American household. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a major emergency in Chicago could have national implications. I'll show you what's at stake for the city and for you. And a financial storm is brewing as credit card defaults have now hit a 14-year high. I'll show you what this means for the economy and, more importantly, your wallet. And after last week's peak in yields, treasuries are now surging back. What does that signal for the broader economy? As you're about to see, nothing good. Now let's head over where we picked today's story up with the headline is Chicago PMI plummets near COVID lows as small business and CEO confidence at the same time is soaring. And when we take a look at the Chicago PMI, it has surged back now down to the COVID lockdown lows in December, falling to a very contractionary 36.9, and this is extremely dangerous news because what it's suggesting, not just for Chicago, but the entire Midwest region, is that they're facing a manufacturing depression. We're seeing levels now that coincide with the bottom of prior crises, and what we're now seeing in the data is it's about to get much worse. Let's take a look at the Chicago Business Barometer, and we're going to go back to the 1980s. We see a recession here, and look where it bottomed just below its current level. Let's move forward to the 1990s. What do we see? We see a bottom in the low 40s. How about around the dot-com bubble? It bottoms right at its current level it's at today. In the global financial crisis, it gets just a little bit lower, close to what we saw in the pandemic, which was the all-time low for the data series. Now, everybody believed that things were only going to get better. We've heard from businesses they can't get worse. Everything's going to rebound. And now, based on what we're seeing from the Chicago Business Barometer, things for the Midwestern region in this country is going to get much worse. And that's going to affect absolutely everybody because what's happening in the Chicago region, well, it's going to happen all across the country. Let's take a look because what we see is prices paid have now risen at a slower pace. And this is a huge problem for the economy and every American household because what we're already seeing is people cannot afford higher prices. But what's happening in the Midwestern region here is they're saying, look, prices are going up because input costs are going up. And this is going to have a massive impact on the labor market because businesses are going to be forced to cut prices. They have no choice because what they're seeing is demand goes down. And when demand falls, well, you have to cut prices to move inventory. And in order to cut prices, you have to cut overhead. And what we saw is new orders fell at a faster pace. And what this is telling us is that demand is indeed going down. Inventories are not moving off of shelves fast enough. What we're going to see is mass unemployment from that alone. And at that rate, what we saw also in this report is another sign the labor market is going to get worse. It fell at a slower pace, but as we know going into next year, if these trends continue, what we're going to see is the entire U.S. labor market come unwound, just like we're seeing in other parts of the world. Now, let's take a look at manufacturers' new orders. This is total manufacturing orders in red against the consumer price index in blue, both on a year-over-year rate of change. And what do we see as new orders slow down? Inflation eventually comes with it because what it's saying is demand is falling. And we see this over and over in the data series, but there's a problem here because input prices are rising, and that means manufacturers have to push those across. They're going to have to look at other ways to cut prices. That means at the margin, and when that happens and you've already cut your expenses everywhere you can, there's one place left you go, and that's to labor. But let's look at this trend because right now the belief, at least we're hearing from central bankers all across the world, is inflation could head higher. What we're seeing based on the new order data is inflation is not going to go higher. It's going to eventually reverse and head lower. Now we know it doesn't go in a straight line down, but you can see the trend. Wherever the red goes, well, what we know is inflation in blue follows. And we can also see it's going to impact the labor market. And this is just the beginning phases of what we see as a massive unwind in the U.S. labor market. We can see here around 2000 going into the dot-com bubble, we see new orders start to slow down, eventually contract. That means there's no work, and we see people people hit the unemployment line and get stuck there. And that's part of the trend we're seeing now. When we look at the data, we see people are on unemployment and they're staying there for 3 months or more. And that's simply because there's no jobs for them to transition back into. And as the economy continues to slow, means more people hit the unemployment line and absolutely no opportunity for them either. How about around 2007, we start to see a bottom in the labor market tick higher, and then that passes through to a complete collapse in new orders. We'll fast forward to right around 2018. Something in the economy changes in a marked way. New orders slow down rapidly and then contract. The labor market starts to bottom. The pandemic stimulus saved the day. And how about now we go back to early 2022? We see a bottom in the labor market pushing higher. Demand comes crumbling down from new orders. Everybody's hoping that things can't get worse, but what we're seeing from the Chicago Business Barometer is things are going to get much worse. But one chart that should be heading higher right now, that is for your trading account. And this morning we're seeing the market melt down, but our trades are holding steady. We had that mystery trade. This is going back to last week. As of Friday's close, it was up 0.98%. That trade went on the books on December 23rd. That was a high value trade. We told our subscribers you need to jump on this. Then the following day we had another high value trade. This showed up on our CTA Timer Pro report. Now what's the difference here? One, we trade momentum. The other, we trade against machine positioning. We put out high quality trades for you to help you make more money in the markets, whether it's in your 401ks, your IRAs, or your trading account. And here's what you get. You get the daily reports. They give you the signals on how to trade. We give you the opinions. I go through every trade and tell you which ones I like and which ones I don't and why. We back test our reports to validate they work. We give you risk control levels, full tracking of all the open trades and returns, a weekly update on Saturdays. Here's the best part. You even get to see what I'm trading. That's right. I trade right off both of my reports. I disclose my trading account to you so you know what I'm trading. You can follow along right with me. And here's the thing, the 30-day free trial is going away at the end of the year. So right, December 31st, midnight, you lose the 30-day free trial. So if you want to jump on this, now is the chance. Links in the description below, because inventories are falling at a faster pace. But what's interesting here is that's happening at a point where businesses are not thinking about taking on more inventory. They're trying to clear out their existing inventory, albeit very slowly. So you think about why aren't they wanting to add to their inventory level? Well, demand isn't there. That's for one reason, and prices are going up. They already know they can't move the inventory at the current levels very well, and at higher prices, it's not going to move at all. Supplier deliveries rose at a faster pace, meaning less demand for shipping means you get your stuff faster. Production fell at a faster pace. This is dangerous news again for the labor market. Order backlogs fell at a slower pace. Possibly we're getting to the end of the backlog cycle. Remember, we've been sitting on nearly 2 years of backlogs here that just got packed up due to the pandemic. We've been wondering when this is going to end, because when that happens, well, just like we're seeing in Europe, as backlogs end, companies are saying, look, we're going to be forced to lay off because we have no work for our people. That's coming to factories all across America. What we're seeing happening in the Chicagoland region is just a pulse of what's going to come all across the country. And when we look at industrial production against the labor market, we see industrial production red on a year-over-year rate of change against continued unemployment claims. And what it tells us is as production slows down and contracts, as you see here, going back to the 1970s, well, it's not good for U.S. labor. And keep in mind, this is a time when we're hearing from the Fed who's saying, look, the labor market's strong. It's going to hold up. It's not going to cause any further deflationary pulses. And we've been saying all along, the data suggests otherwise. It's getting very clear now from Chicago, suggesting what's happening there is going to spread all across the country. You can see here going into the mid 70s, what happens, industrial production rolls over, heads down, and so too the labor market gets unwound. You see that happen going into the 1980s, going into the 1990s, around the dot-com bubble, again in the global financial crisis. And look what's happening now. You see industrial production is slightly negative on a year-over-year rate of change, and people are getting on the unemployment line and getting stuck there. And this is a problem because as they spend more time on unemployment, their spending goes down, not just because their check is smaller from unemployment than their paycheck was, but they realize that their opportunity to re-enter the workforce is going away. They're forced to cut expenses at a time when interest rates are relatively relatively high. So you see high debt service costs, high inflation in terms of insurance costs, housing costs, food costs. It's all there, and that means less discretionary spending as people go on the unemployment line, and that's going to backfeed all through the economy. You see new orders declining. Everything here is pointing to the U.S. economy heading right into a recession. And let's take a look at capacity utilization, because when we see factory capacity go down, well, it has a great relationship with the consumer price index, because when factory capacity falls below 80%, well, it means inflationary pulses in the economy are going away. We look at capacity utilization in red, and you can see up here, this is right around the 80 mark up here. And as it comes down, what happens? You see the consumer price index in blue, it goes down as well. So the notion here that we're going to see a resurgence in inflation is only a possibility if it's transitory, because when you look at what we're seeing at industrial production, you look at capacity utilization, you look at what's happening in Chicago and what's going to happen in the labor market, you can see demand's going to go down. And if you own a business and demand goes down, you don't raise your prices. You look for ways to cut your prices because you've got to clear off that inventory. It's a big issue here, all telling us inflation is going away. But let's take a look here, because we see a tumble in the survey sentiment fits the overall slump in soft data since Trump was elected. And what we saw is everyone got excited, but the survey data was suggesting that the hard data shown in red is going to turn to the downside. We haven't seen that yet, but it follows with a lag. And this is interesting because looking at small business and CEOs from large business, confidence has exploded higher from the election, because everybody's been saying that the reason nobody was spending was because of the election. And yet I've talked to people every day, and not one person said, yes, I was withholding my spending because I was not sure who was going to take the White House. And now that Trump's got elected, I've heard nobody say, I'm going out and spending big because I'm confident about the economy. The problem here is that business owners, they have no other reason but hope. And that's the challenge here, because hope that something was going to change. Well, if it doesn't change, and that's the problem with the economy, looking at the data here, it's suggesting things are going to get worse, and many small businesses have been struggling for 3 years running now, meaning if things don't get better, many of them could face insolvency, bankruptcy, and forced to have layoffs. It's not going to be a pretty picture at all. And this does make one wonder who the local Fed surveys are asking, because small business optimism here is shooting higher. Meanwhile, we're seeing from the surprise index, this is red, and surprise meaning is going to the downside, meaning that business owners are saying they think one thing's going to happen. The opposite is actually happening. So surprise moving to the downside. What it's saying is this optimism is going to be short-lived, because what's really happening in the economy does not get changed based on who takes office. And this is something we've been warning about. It doesn't matter who's president, because they can't immediately change the pace of the economy. The U.S. economy is too big and moves too slowly, and now it's completely obvious it's trending right into a recession. While there's a lot of hope that things are going to get better, unfortunately, a lot of business owners are going to find out it's going to get worse, and that means for U.S. workers, the ultimate is coming, and that is mass layoffs. And let's take a look, because you can see it filtering through the economy, how it's going to impact businesses here in a big way, as credit card defaults now surge to a 14-year high. And this is not the sign of a resurging economy. It's not the sign of a soft landing. It's a sign of an economy. It's going to get worse, because when consumers enter default, they lose access to credit. Well, there goes your spending power. And here we can see card lenders wrote off $46 billion in seriously delinquent loans in the first 9 months of the year, a 50% jump over 2023. So clearly, any signs of a soft landing, not in this data. What we should be seeing is the opposite, that they're writing off less debt because people are able to catch up with their defaulted payments. We're not seeing that happen at all. And that's the highest level in 14 years. That is dangerous for the economy, because it all comes back to the U.S. labor. See, we look at what's going on in the economy, and we see everything got stretched due to all the pandemic stimulus, and as stimulus went away, people had less money to consume with. As they had less money to spend on the economy, slowly you see the economy shift to the downside. Now it's impacting labor, because the supply and demand mismatch has now switched. Now we have too much supply and not enough demand, and that means demand for workers also going down. Here you can see when we look at the delinquency rate on credit cards. This is only shown on a quarterly basis, but you can see in periods where it's rising here in the mid 90s. What happens, you see usually a follow through on the labor market, continued claims heading higher. What you're seeing here is people not able to afford their debt service payments. Here going into the dot-com bubble, continued claims are rising, meaning people again can't afford their credit card payments. Delinquency rates rise. You see that relationship start right around 2007, and look what's happening now. Everybody believes things are turning around, but for many American households, it's getting worse. And while high-income households are fine, the bottom third of U.S. consumers are tapped out, and the steep increase in defaults indicates the financial pressures facing consumers after years of elevated inflation and higher borrowing costs. But that's the excuse. It's always about, well, inflation was too high, interest rates are too high, but that's not what it is, because those are issues. If the economy was booming, would not be a problem for consumers. The issue comes back again to the labor market and wages as we look at total incomes in the form of average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. They're shown in red on a year-over-year rate of change, and now we get a much better picture of why the delinquency rate is rising, because what happens in 1994 is income growth peaks, it starts to slow down, and what happens for a lot of Americans? Well, they can't afford the payment on their credit card. They go into delinquency. But what happened in around 1996, the economy shifted a little bit. They were able to stop that trend. Well, then we entered the dot-com bubble, and you can see once again, incomes peak, they decelerate, people can't make payments on their credit cards, and in a debt-based economy, it sends you right into a recession each and every time. You see this here right around 2007, you get a deceleration in incomes and then a corresponding rise in delinquency rates. Now we're seeing the same thing in default rates, and we mentioned this would happen. We said delinquencies eventually turn into defaults if people can't afford to make their payments, and sure enough, now that number is going up and going to get worse. And while banks still haven't released fourth quarter earnings, we don't actually know how much worse things have gotten. There are early signs that more consumers are falling behind. For example, Capital One said recently its annualized credit card write-off rate, the percentage of overall loans that are considered unrecoverable, hit 6.1%. Up from 5.2% a year ago. So once again, you see no indication of a soft landing. So we go back to what's happening in Chicago. We make the case of why this spreading all across the country. We're already seeing it. What this means is things are going to get much worse and fast. Consumer spending power has been diminished. Well, that's obvious, because how do U.S. consumers spend? Well, they take money they don't have and buy things they don't need. And what we're seeing in this case, if you're delinquent or even in default on your credit card debt, that means your access to more credit is gone. And without the access to credit, well, for many Americans, that means no more spending. And that's why when we look at the delinquency rate in blue against real retail sales, that's shown in red on a year-over-year rate change. What we can see is as the delinquency rate rises, what we should expect to see, and we do see, is a corresponding deceleration in real retail sales. We see that happen there in 1994. Here again in 1999, right around 2006, we see it. And again, we see it today. Everybody says, well, look, everybody's turning around here. The election's over. Consumers are going to come out and spend. But what we're seeing in the delinquency rates and the default rates is saying just the exact opposite. It's going to backfeed right into the industrial base of the U.S. economy. And that's exactly what we're seeing in Chicago. They're saying, look, production's down. New orders are down. Everything is getting worse. And we're seeing this at levels associated with the depths of prior recessions or financial crises, indicating that we're not even there yet. We're not at the bottom yet, and that means things are going to get far worse before we see things turn around. And data from November from the Credit Access Survey released by the Federal Reserve Bank of New York showed that consumers were having more difficulty accessing credit for auto loans and mortgages, especially for consumers with low credit scores. And why is that? Because banks care about one thing and one thing only when they lend. It's getting their money back. So what they're seeing is even if people have a low credit score, their banks are saying, look, we don't think the economy's turning around. We're not buying into the soft landing narrative. We don't believe that the Fed's cutting rates is going to make a difference, because if the banks believe things were getting better, they would extend credit thinking they're going to get their money back. They don't do that when they think things are getting worse, and that means Of course, in a debt-based economy, the lifeblood is the expansion of credit and spending. Without the banks doing that, we know things can't get better. And reported rejection rates for credit cards, mortgages, auto loans, and credit card limit extension applications and mortgage loan refinance applications all rose in 2024 as more people demanded credit. Banks said not a chance. But what's interesting here is we're seeing investors positioning to make the next crash even worse. We saw today a rebound in treasuries as they extended their rally as yields retreat from last week's peak. But what does that mean? Well, nothing good for the economy, because when we look back at total manufacturing new orders against 10-year treasury yields, what we see is a nice relationship. As we see a slowdown in new orders, yields come down. In a debt-based economy, it makes perfect sense because lower interest rates are supposed to spur consumption. Now, the problem we face right now is investors believe interest rates need to go up and up even more. It's going to have damaging effects on the economy, and we're going to see a massive reversal in rates at some point. Days not today, but maybe the beginning of a trend. And you can see that with the delinquency rates. If people can't afford to make their payments now, what do they need? They need interest rates to come down to drop their minimum payment down. Again, investors betting big on rising interest rates. This is going to have long-term damaging effects on the U.S. economy. It means during the next cycle, not only are we going to see a new all-time low in rates, they're going to stay there for a lot longer than people realize. And as we look back to Chicago, what we see, what's happening in Chicago is soon going to spread all across the country and put many Americans on the unemployment line with zero or little opportunity to get back, meaning we're facing a potentially prolonged recession or even outright depression. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.